If you truly master supply and demand, the way you look at charts will change forever. It won't just help you make profits, it can help you capture much bigger, high-probability moves. In this video, we're going to cover everything you need to know about supply and demand. If you're serious about mastering this concept, I have one request. Don't skip any part of this video. By the end of this lesson, you'll learn what supply and demand really are, why every trader should use them, how to identify and draw supply and demand zones on any chart, how to trade these zones with confidence, including the best entry and exit techniques. And at the end of the video, I'll reveal the exact supply and demand strategy that I personally use, so you can see how I identify high-probability setups and execute my trades. Now let's begin the video by understanding the basics of supply and demand. So, what is supply and demand? In simple terms, supply and demand are nothing more than aggressive selling and aggressive buying. Aggressive buying and aggressive selling reveal where the big players, also known as smart money or institutional traders, are entering the market, where they're exiting, and the direction they're pushing the price. Take a close look at this candlestick pattern. These large red candles indicate aggressive selling. This tells us that heavy volume and strong bearish momentum entered the market, driving the price lower. Now, look at the next chart. Here you can clearly see aggressive buying. This means the big players are pushing the price higher with significant volume and strong bullish momentum. These are the key signals you should focus on when trading supply and demand. Strong momentum helps you identify where smart money is entering the market, which direction it's driving the price, and where it may be taking profits or exiting positions. On the other hand, when you see a group of small candlesticks, don't mistake them for a supply or demand zone. Think of these small candles as the market's little babies. They usually represent low volume, weak momentum, and a lack of institutional participation. Why should you trade supply and demand? First, let me explain why I personally trade supply and demand. The goal is simple. I want to trade alongside the people who have the power to move the market. The institutional traders, often called smart money or the big players. Instead of trading against them, I prefer to follow their footsteps and profit from the moves they create. The best way to identify where smart money is entering and exiting the market is by recognizing supply and demand zones on the chart. When price drops with large, strong bearish candles, it forms a supply zone. This tells us that aggressive selling has entered the market. On the other hand, when price rallies with large, powerful bullish candles, it creates a demand zone. This indicates aggressive buying by institutional traders. When analyzing charts, don't focus on every candle. Pay attention to strong momentum candles because they reveal where the big players are actively participating. Always remember this: we are retail traders. Compared to institutional traders, our capital is tiny. Large institutions manage hundreds of millions or even billions of dollars, giving them the ability to influence market direction. When you see a powerful momentum move on the chart, it's often a clue that smart money has become active at that price level. Now, ask yourself this: would you rather trade with the institutions or against them? If your goal is to become consistently profitable, the answer is obvious. You want to trade with the money that moves the market, not against it. One of the biggest mistakes retail traders make is trying to fight institutional order flow. That's a battle you rarely win. Instead, learn to identify where smart money is active, align yourself with their direction, and let their momentum work in your favor. How to identify supply and demand zones on the chart. Now let's learn how to identify supply and demand zones on a price chart. Method 1. The momentum candle method. The first rule is simple: only consider a trade if you can see at least 3 strong momentum candles. Sometimes a momentum move may contain 4 or 5 large candles, but you should have a minimum of 3 strong momentum candles before considering a trade. Take these 3 strong bullish candles as an example. Notice that we're not treating small candles as supply or demand zones. Next, identify the candle just before the momentum move started. Draw a rectangle that completely covers the high and low of that candle. The rectangle you've drawn becomes your demand zone. The next time price returns to this zone, you look for a buy opportunity. In this example, price revisits the demand zone and then rallies sharply with large bullish candles. If you can consistently identify and trade these high probability zones, you'll put yourself in a much stronger position to capture significant market moves. Another example. Now let's look at 3 strong bearish momentum candles. Select those 3 candles, then locate the candle immediately before the momentum began. Draw a rectangle covering that candle's high and low and extend the rectangle to the right. This rectangle becomes a supply zone. Now wait patiently for price to revisit that area. As price returns to the supply zone, it pauses briefly, consolidates, and then forms a strong bearish candle before dropping sharply. Price is clearly rejected from the zone, showing the strength of the institutional selling pressure. This is how you identify a high-quality supply zone. Method 2. The consolidation method. Now let's look at another technique. In this chart, price moves sideways within a tight consolidation range. Use the rectangle tool to cover the entire consolidation area and extend it to the right. Watch what happens next. After breaking away from the consolidation, price later returns to retest the zone. As soon as it touches the rectangle, it gets rejected and starts moving lower. This shows how a consolidation area can act as a strong supply or demand zone after the breakout. Method 3. The rejection wick method. The third method is based on multiple long rejection wicks. Look for areas where several candles have long wicks. These wicks tell us that price was repeatedly rejected from that level, indicating strong buying or selling interest. Draw a rectangle that covers the entire area where these rejection wicks formed and extend it to the right. Now watch what happens when price returns to that level. As soon as price touches the zone, it rallies aggressively with large bullish candles. This confirms that the area is a strong demand zone. By understanding these 3 methods, the momentum candle method, the consolidation method, and the rejection wick method, you now know how to identify high-quality supply and demand zones on any chart with confidence. How to trade supply and demand zones. In this chart, we've identified 3 strong bullish momentum candles. Now we'll draw a rectangle that covers the high and low of the candle just before the momentum move and extend it to the right. This creates our demand zone. Now we simply wait for price to return to this demand zone. 2 ways to enter the trade. There are 2 common ways to enter a trade. 1. Place a buy limit order so that your trade is triggered automatically when price reaches the demand zone. 2. Enter manually after price reaches the zone and gives confirmation. I personally prefer the second method because no matter how strong a demand zone looks, there's always a chance that price could break below it. Waiting for confirmation helps filter out weak setups. Wait for confirmation. As price returns to the demand zone, don't enter immediately. Let the market confirm that buyers are taking control. Notice that a doji candlestick forms with long wicks, indicating rejection from the zone. However, that's still not enough confirmation that price will move higher. The very next candle is a strong bullish engulfing candle, confirming that buyers have stepped in. This suggests that smart money is building long positions, and once institutional buying enters the market, price often moves upward with strong momentum. This is where we enter the buy trade. Our stop loss goes below the most recent swing low. If you want to be more conservative, you can place your stop loss just below the entire demand zone. Setting the target. To determine our profit target, look at the previous price action. You can see 3 consecutive bearish candles, and just before them there's a candle with a long rejection wick. This confirms the area as a supply zone. So when price reaches that supply zone, we take profits and exit the trade. When a zone stops working. If a supply or demand zone no longer holds and price breaks through it, simply delete the old rectangle and identify a new supply or demand zone. If no new high-quality zone is visible, the best decision is to stay patient and wait. For example, when price creates 3 strong bullish momentum candles, we identify a new demand zone by drawing a rectangle around the candle immediately before the momentum started and extending it to the right. Then we wait for price to revisit that zone. Another trade example. In this area, we can see several candles with long rejection wicks. That allows us to mark a supply zone. Later, when price returns to the demand zone, it briefly breaks below it with a strong bearish candle. At this point, many retail traders panic and interpret it as a bearish breakdown, entering short positions. However, the next candle is a strong bullish candle confirming that buyers have regained control. This is our signal to enter a buy trade. Our stop loss goes below the last swing low, and our target is the next supply zone. Price then rallies with strong bullish momentum and successfully reaches our target. My personal supply and demand strategy. If you've watched this video this far, I'd like to share the strategy I personally use when trading supply and demand. I never rely on a single confirmation before entering a trade. Instead, I wait for multiple confirmations, which helps improve the quality of my setups and increases my overall win rate. One of my favorite confirmation tools is the Fibonacci retracement. I only use the Fibonacci tool when the market is clearly in an uptrend or downtrend. I never use it in a sideways or ranging market. In this example, the market is in an uptrend, so we draw the Fibonacci retracement. The 0.50 50% and 0.618 61.8% retracement levels are the areas I pay the most attention to. When price pulls back into this zone and forms a bullish confirmation candle, it gives me additional confidence that the market is likely to continue higher. Only after receiving these multiple confirmations do I enter a buy trade. This approach helps me avoid low probability